This is the Tax Insights Podcast, where the Hawkins Ash CPAs professionals break down complex tax topics into bite-sized how-tos. With a Roth account, you would not receive a tax deduction on your contributions, but you will also not have to pay tax on qualified distributions. With today's low stock values, Jeff Dvorachek, a tax partner, explains how contributing to or converting existing funds to a Roth account may be advantageous.
Yeah, as we all know, last year was not a good year for the stock market. But when the stock market gives us lemons, they always say there's an opportunity to make lemonade. So this may be the perfect time to convert some of your IRAs or other retirement accounts to Roth.
All right, so I think I know the answer, but let's talk about it. Why right now?
Well, with stocks taking a 20% or more haircut last year, the values are down right now. So if you do a conversion right now and the prices go up, all that increase in value is going to come back to you later tax-free.
Because you don't pay tax on Roth withdrawals, right?
Right. So let's back up one step. When you contribute money to a retirement plan, you normally get a tax deduction. But later, when you take the funds out, you have to pay income tax on both the contribution and the appreciation. But with a Roth, you do not get a tax deduction when you contribute, but you also don't have to pay tax later on either that contribution or any increase in value. So like we were just talking about, with the stock prices being lower, it may be a perfect time to either contribute or convert.
So there are limits, though, to how much you can actually contribute, correct?
There are. As we discussed last week, if you contribute to a Roth IRA, the most you can do in 2023 is $6,500 plus an extra $1,000 if you're 50 years or older because of the catch-up. And remember, if you didn't make a contribution for last year, you still have until April 18th to do that. Now, the limits were a little bit lower last year, so just make sure you're not contributing too much. And as long as your income is under $218,000 if you're married or $138,000 if you're single, you can contribute the maximum. Now, you can still contribute if your income is higher, but the contribution limits do go down a little bit.
So does that change if you have a Roth 401k with your employer?
It does, because the income limits that we just talked about, that goes away, and the contribution amounts go up. So we also talked about this last week, but with the Roth 401k, you can put away $22,500 into a Roth 401k. And if you're 50 or older, you can even do another $7,500 on top of that for a grand total of $30,000 for those 50 and older.
So you also talked about Roth conversions, correct?
Yeah, and this is a really good way to get retirement funds into your Roth accounts. You can actually convert part of your traditional IRA into a Roth IRA at any time. There's no income limit, so anybody can do this. Now, the only catch is that you need to pay income tax today for any Roth conversions made. So you're going to want to make sure that you have some cash on the side to be able to pay that tax.
Can you also do a Roth conversion in a 401k?
Yes, as long as the plan allows it, and most plans now do. But once again, you want to make sure you have some cash on the side to pay the tax. For most people, it doesn't work well to use 401k funds to pay the tax, since this is considered to be a distribution, and that amount that you take out just to pay the tax might be also subject to tax and penalties.
Lastly, Jeff, we've talked about in the past about a backdoor Roth. Can you explain this a little bit?
Yeah, so this is still another way to get funds into your Roth IRA. Now, this plan only really works if you don't have any other traditional IRA funds. So if you don't have any traditional IRAs, I would ask your investment advisor or accountant about this.
Jeff, great information, great discussion each and every week here in Tax Insight. How do listeners connect with you and the team over at Hawkins Ash?
I would visit our website, hawkinsash.cpa, like us on Facebook, or even follow us on YouTube, because we have a whole bunch of these type of bite-sized tax tip episodes.
Jeff, thank you for your time. We'll talk to you next week.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs, part of your business, part of your life.